All right, let's move on to the last chapter that we cover in this course, which is intangible assets. Intangible assets are also non-current or long-term assets, and they sit on the balance sheet, typically after fixed assets or property, plant, and equipment. And they are called intangible because they don't have physical substance. But as is the case with fixed assets or property, plant, and equipment, we do have to recognize their usefulness to the business and apportion some of its cost to the business on an ongoing basis. This is true of many of the intangible assets. And so, but rather than using depreciation or depletion, what is the term that's used for intangible assets is amortization. Amortization works much like depreciation. The goal is the same, which is to match the benefit derived from the business to the asset, and we do that over time through this technique called amortization. So let's look at what some of these intangible assets are, then we'll look at amortization. So characteristics: lack physical existence, not a financial instrument. So they're not bonds, they're not stocks, and they're almost always classified as long-term assets. So although hypothetically they could be a short-term asset if we expect to get less than 1 year life from them. So patents, very big in the in technology and biopharma. Copyrights, related to creating creative materials, franchise or license fees, trademarks, important for a lot of businesses. And then what you'll see on a lot of large companies is something called goodwill. So when people think of goodwill generically, we think about the good feelings that others have towards us, but that is not what this means when it comes to intangible assets. When it comes to intangible assets, what goodwill is when one company acquires another and it's determined that they paid more than the fair value of their net assets, then the difference between the purchase price and the fair value of their assets is something called goodwill. So that's all goodwill is. And so one of the things you have to recognize about goodwill is that if you don't acquire another company, then you don't have goodwill. So companies, for example, like Coca-Cola, like Facebook and others, don't generate goodwill simply by branding and advertising. They only generate goodwill if they acquire another company. So let's talk about valuation. So purchased intangible assets recorded at cost includes all the costs necessary to make the intangible asset ready for intended use: purchase price, legal fees, other incidental expenses. Internally created intangible assets, we can record those at cost, but it's generally expensed. Okay, only capitalize direct cost incurred in developing intangibles such as legal cost. Okay, so generally speaking, internally valued assets are not capitalized, generally speaking. So amortization of intangible assets. Limited life intangibles amortized to expense over useful life. Okay, so it works much the way depreciation does. We debit amortization expense, we credit accumulated depreciation. And again, we use the useful life expected for the asset, and we'll also reduce from the cost any residual value that the company may have. Although, as is the case with property, plant, and equipment, residual value is often ignored. And we want to constantly reevaluate the limited life intangibles for impairment. Okay, indefinite life intangibles, okay, and this is goodwill, for example, no foreseeable limit on the asset expected to provide cash flows. So in this case, we don't actually amortize. We basically do impairment testing. And again, impairment testing is beyond the scope of this course because it gets pretty technical. It's a pretty high level area that you'll cover in some of your high level courses. But basically, going to look at the stream of cash flows discount them to present value and look at the cost of the asset that's on your books. And as long as the stream of cash flow is equal to or exceeds the asset value, then nothing is done. If the stream of cash flows becomes less than the asset on your book, then you won't have amortization. You'll have something called impairment loss. Okay, so that's the main difference between amortization and impairment. So you capitalize, whether it's limited or indefinite, you're going to capitalize them. Generally speaking, internally created items are going to be expensed. Limited life, you're going to amortize. So limited life, things like patents, copyrights, they're limited by law, and they're also limited by the usefulness to the business. So whatever is shorter is the useful life. So here's 6 major categories of intangible assets: market related, customer related, artistic related, contract related, technology related, and goodwill. So marketing related, trademarks, trade names. Okay, here's some examples. You can read through this material. Customer intangible assets, customer list, production backlogs. Another example, artistic related, copyrights, franchise, contract related, franchise, and technology related. Patents are the big thing, right? So technology and pharmaceutical companies, spend lots of times developing products, and their main protection is to get a patent, which gives them the exclusive right to use that particular. And goodwill is, as I mentioned, only occurs when the excessive cost of the purchase of another company over the fair market value of the identifiable net assets less liabilities purchased. Okay, so the only time we record goodwill is when an entire business is purchased. So here's an example. Read through the examples. I don't think it's value for me to read it to you. Okay, and we're going to put it on the books as goodwill. We're not going to amortize goodwill though. These other assets, patents, copyrights, other things with limited lives will amortize, but goodwill we do not amortize. So we'll put it on as goodwill, and then we do an impairment testing. This walks through the calculation of goodwill, which again, you can read through these slides. So goodwill considered to have an indefinite life should not be amortized, only adjusted when goodwill is impaired. So limited life intangibles can also be impaired, right? So again, we're going to use the same impairment testing process. Look at the future cash values. If it's less than what we've recorded the asset on the books, then we have to write down the asset or write off the asset. All right, so again, you can read through the slides. So goodwill should be tested for impairment at least annually. Okay, so if it's at risk, probably more frequently. And we want to make the write-off immediately when we recognize that the impairment exists.